Hello. Good evening, everyone.
Yeah, it's a first for us. We figured we'd see what the buffet looked like, and hopefully after this is done, we'll be able to try it. So,
Kevin had his eye on the comfort food at this buffet here. Nothing but
it's looking
pierogies.
really good.
Well, we're glad everyone could join us again. It has been a little while since we've been able to do an in-person event, so it is nice to get back to doing these kind of get-togethers. One item that will be a little different this time around is we are going to film the presentation. They have the camera at the back there. The focus is on the presenters. So they'll film myself, Kevin, Adam. They will not be filming the audience.
Yeah, so anybody who is hoping to get on reality TV, this is not the place to do it.
Yeah.
We're telling you now.
We'll start with a quick update. I know we do this every time, but certainly believe it's important, so worthwhile to review, and we'll start by talking about the firm involved.
Yeah, we are basically, that's Clinton, I'm Kevin. We are Becker Orr Wealth Management. We are part of Canaccord Genuity Wealth Management. We are the largest independent full-service firm in Canada. We are actually a global player. We have offices here. We're in the UK. We're in Australia. We do have offices in the United States as well, so that helps us as a global brand that we can deal with. Also, we are a member of what's known as the CIPF, or the Canadian Investors Protection Fund. That's the insurance agent. It's the same insurance backing that the big bank firms have. So, again, that is another, if anything goes on with the firm, your investments are protected in that format, so it can give you peace of mind. And that helps us with marketing ourselves for a lot of people out there. Other than that, there are more on an individual basis. And, Clint, do you want to talk about who we are in general?
Yeah, I'll talk about us. You can see our photo on the slide there, and all the full-time members are here today. So you have the portfolio managers. That's myself and Kevin. I was about to point to Adam Buss, but I think he just disappeared for a washroom break before his presentation. And then you have our full-time staff members. You have Alicia Roche as well as Mark Irwin, who are both here tonight. And then all the part-time staff members that are helping out. You have Jody Voss, Janet Anderson, Tiana Bird, all here tonight as well. And the events like this, Kevin and I have the easy role. We just show up and we talk. Yeah. But a lot has to go into planning the event, so please, a big round of applause to the team that made it possible. And as a team, our promise to each and every client, it is commitment, clarity, and confidence. For us, commitment, it's really all about communication. You need to hear from us. We need to have conversations, whether it's events like this, in person, Zoom, whatever the case may be. Those lines of communication have to be open. If we do our job there, it should lead to clarity. Clarity in the goals, clarity in the objectives. Most importantly, we want some peace of mind and clarity when it comes to the financial plan. High level of commitment, high level of clarity. The end result is confidence. Confidence in our team, confidence in our process. As I mentioned, we want some confidence in the financial plan. I mentioned the process. I'll quickly comment on that. Quirky title, but we call it financial architecture. The idea is if you're going to be building a home, you can't just zoom in on one piece. Lots of decisions need to be made. We can't just pick the paint color in the kitchen. We've got to make sure there's a solid foundation, a secure frame, as well as design the interior. Same thing in the financial world. For us, the financial foundation of that home would be the estate. It's your insurance needs. Once those are taken care of, you can worry about the frame. That's when you talk about tax planning, retirement planning, which we'll address tonight. And what you do there will influence the interior, which are the investments. It all has to work together. So please keep that in mind throughout the presentation. So we'll jump into the market update. And Kevin has the privilege of talking about what happened in 2022.
Yeah, I get to start off with this whole fun scenario that everybody's been waiting for. I would like to say 2022 has not been as robust as the previous 2 years has been. It's probably the easiest way to put it. We have seen bear markets come around, and we're in a bit of a downturn at the moment. If we take a look, the chart that's up there right now is the S&P 500. So as we can see, they are technically in bear market territory, which is if you're 20% or lower, that's a bear market. They're down about 25, 26. But again, as bad as this has been over the first 9 months of the year, it is not down as much as it was during the pandemic for roughly a 4-week time period, which was down roughly 36%. Now, again, a lot of this has to do with some of the events that took place in the pandemic, and that's what we wanted to discuss going forward for what's happened. The pandemic, when it came around, of course, everything shut down. There was great fear, but the government helped out in a whole bunch of ways. First of all, the banks centrally, globally, lowered rates to roughly zero. And government stimulus was thrown out there completely. So there was lots of money to be able to let everybody survive. That, of course, has led to the present area where we're at today. You cannot continue to do this. The biggest topics that we've got going on, or the biggest buzzwords that are out there, are inflation, interest rates, and recession. Of course, the basics on inflation, it's too much money chasing too few goods. And the way to stop that is to give them an alternative. And the alternative is, as opposed to spending your money, if they raise interest rates high enough, you'll save it because you're going to make more doing that than enjoying some of the perks. So those are some of the big questions that we want to deal with. And that's part of what we're dealing with right now, is that interest rate and inflation scenario. Now, if we take a look at the Canadian market, we're not quite as bad as the Americans. We're down roughly 18 to 19%. We're going to be close to 20, possibly by the end of this month. But again, we were down further in 2020 during the pandemic timeframe. And that's something that we really need to sort of take a look at. It's been a global event, though. This hasn't just happened in North America. This is happening in Europe. It's happened in Asia. And part of the reason for why the extent has gone on right now is not only the inflation that I've mentioned beforehand and the interest rate movements that are going on, but it was exacerbated by a few other options. One of them was China and its zero policy COVID means that we've had a supply chain shortage. During COVID, there was nothing open, so that's why you've got prices going up. The other factor has been the Russia invasion of the Ukraine. That, of course, has caused every commodity price on the planet to go up as well. So this has just helped to build the inflation side as going forward. But again, this is not a permanent scenario. We basically haven't had a real recession in roughly 12 to 14 years. So this is the first that we've seen. Not only that, but we're probably getting closer to where the end of this is as opposed to the beginning. There's a variety of other options just besides what I've talked about. And some of those, Clint, you can touch base on now.
Sure. If we're going to talk about what happened, I think you need to mention the U.S. dollar, and you have to dive a little deeper into interest rates. The U.S. dollar, that's the chart you see here, the top panel, the U.S. dollar index, the bottom panel, the S&P 500. The U.S. dollar so far has been negatively correlated with the stock market. U.S. dollar goes up, markets are going down. It's really been that simple for the last 18 months. That is not always the case. It doesn't always work like that. The correlations do change. But for really midway through 2021 until today, that has been the case. So the top panel there is not Canada versus the U.S. It's not that exchange rate. It's looking at a basket of currencies. So it's the U.S. versus a basket of currencies. It looks at the euro, the yen, it looks at the British pound, the Canadian dollar, the Australian dollar, a basket of currencies. And against all those different currencies, the U.S. is still seeing significant strength. You've seen a surge in the U.S. dollar. Part of the reason why, in our mind, is because of what Kevin mentioned earlier. It's a global event we went through. Canada and the U.S. didn't just have to deal with the pandemic. Everyone did. All the countries responded pretty much in the same way, in the fact that they had some form of restriction and then a significant amount of stimulus. So all those countries are still dealing with inflation and the economic pressures that come from that. And in that global event, I think it became pretty clear that the U.S. is still the safe haven currency. Rightly or wrongly, that is still very much the case because everyone flocked back to the U.S. dollar, and you've seen this significant rally in the U.S. dollar in the last 18 months, and it's coincided with the drop in the stock market. So in our mind, until we see the U.S. dollar kind of plateau, not that it'll collapse or drop, but it just has to stop going up, and that could be part of the catalyst for a market rally. But right now, the two are very much linked. So the U.S. dollar, part of the reason we've seen the turbulence. The other big item is what you mentioned earlier, which is interest rates. Mm-hmm. Interest rates going up isn't really a big issue. That happens periodically. Every couple of years, they normally tweak the interest rates. It's the pace at which you see the increase. And what we've seen in 2022 has been a very rapid increase in rates. Really one of the most fastest rate hiking cycles we've really ever seen from the central banks. And that's what's depicted in the chart here. The top panel is the bond market, represented by the ETF, AGG, and then the bottom one is the 10-year Treasury yield for the U.S., so that would be representative interest rates. There's an inverse relationship there. So as rates go up, usually bond prices come down. If rates go up very rapidly, you see what happened in 2022 when bonds fall quite significantly. Now, bonds are normally the safe investment. Often people will have a mixture in their portfolio. They'll have some stocks, they'll have some bonds, and that's how they diversify. That would be a traditional portfolio. Normally, if one is down, the other is up. In 2022, we had a very rare event because of the rapid increase in rates where both stocks and bonds were down in the same year. And that's why you've seen a little more damage to a traditional portfolio than perhaps in other bear markets, is because you had that rapid rise in rates that have hurt the bond market. And if you're talking about interest rates, I think a logical question is, all right, if rapid increase in rates is part of the problem here, how high are we going to go with interest rates? When do you see a peak in that rate cycle? This is a very busy chart, but I'll go through it and it'll help us answer that question. The two lines there, the orange and the blue, if you want to think about it from a high level, the blue can be inflation, the orange would be interest rates. The blue, there's lots of ways you can measure inflation. It's not just one inflation number. There's probably about a dozen. That blue line specifically is the core PCE price index, which is one measure of inflation. The orange line is the central bank Fed funds rate. So again, inflation, interest rates. In the past, the rate hiking cycle has not stopped until interest rates are higher than inflation. Or on that chart, you'd see a cross, orange line above the blue line. So if you look across the past decades, the orange line doesn't stop going up until it's above the blue line, and we haven't seen it yet. They're getting close, but you haven't seen that cross, which in our mind indicates there's still more room to run in rates. We're not done with this rate hiking cycle. In addition, you'll notice the gray shaded zones on that chart. Those represent economic recessions. And usually when you see a big spike in interest rates, so a spike in that orange line, it follows a recession. You see those gray shaded zones happen right around the spikes in interest rates. We do think it's likely that an economic recession will happen this time as well. It's possible we're already in one, or if we're not, likely 2023 is when we'd see that economic recession.
Yeah, and if you notice on that last slide that Clint just had, the gray bars there are fairly small, and the big white spaces between them are fairly large, and that's traditional of a typical market. What basically happens is your average bear or recessionary market usually lasts anywhere from 9 to 12 months, and then you're usually followed by a bull market that basically lasts anywhere from 60 to 72 or 5 to 6 years. So if this is true on the way we've been going right now, we're closer to the end of where this recessionary time frame is before the markets start to move. And again, another key indicator is markets are a leading indicator. So even though we may not be in recession yet, or we may be getting close to it, the markets will turn long before the recession ends because it's an indicator as to where things are going. So once the rate hikes stop, once we start seeing inflation come down a little bit more, you'll start to see markets turn fairly quickly, even if we are still in recession. So that's a positive for where we look at going forward. Now, another key indicator that seems to be out there is talking about the U.S. election. Now, they have an election every 4 years, but they have midterms every 2 years. Since World War II, every time there's been a midterm or a presidential election, just before that happens, you usually get the markets to react. And they react fairly negatively, and that's because of the uncertainty out there. The one thing markets don't like is uncertainty. They like to know what's going on. So when this election comes up in November, what we're going to find out is, I don't know whether Republicans are going to win the House or the Senate or Democrats. At the end of the day, it's going to be irrelevant. As long as that happens, and once the event's done, the U.S. knows for the next 2 years they have a set government. They know what's going to go on, and that puts them at ease a little bit, and you start to see sometimes that Santa Claus rally come around. So just based on this chart, we're following pretty much along the same line. We're going down. After the election comes, I would expect that we're going to see it start to go up again. And if we take a look at the slide that comes after this, this is since World War II. If you look to January, you'll notice that numbers can be negative or positive. But anytime you get to June after the midterm elections, every market has been positive after that time frame. I don't think this is going to be any different. So it may not end the year above where we are at the moment, but it should be positive from where we were at that January sort of time frame. So again, this is just another indicator that helps. There is no written rule that says everything's going to go the same way this time, because this is a little different than everywhere else. We haven't really come out of a pandemic since the early 1900s, I guess would be the last time, so it's a little bit unprecedented. But this is just another area where we think things are going to head. And besides heading, there are things that we see going on that may change some of our view. And Clint, what are some of those?
Yeah, so the goal is to try to find the most probable path forward, which Kevin just described. In our mind, it looks towards a year-end rally with more recovery in 2023. But we have to make sure we're on the lookout for items that tell us we're no longer on that path. What would make us change our mind and adjust our strategy? And we have a couple of them listed on that slide there. One is we'll listen to price. If market keeps going down, well, that's an indication that that probable path forward is not on track. We have a few items there. If it goes below the June lows or what we'll call the secular trend, well, then we know we need to change direction. Related to that would likely be interest rates and inflation. Those are very key to this particular market correction, this particular market cycle. Right now, inflation, we're seeing the numbers get smaller. It's still quite high, but it looks as if the peak of inflation is in the past. If that starts to change, well, we're going to have to change our view and change our direction with our portfolio. Similarly, it looks as if interest rates, remember that prior slide with the orange and the blue line, we're not quite done the cycle, but we're getting close to a peak in rates in our mind. If that's not the case and rate hikes keep going higher, we're going to have to change our view. So those are three key items we're watching to see if that probable path does in fact unfold. I know we did that quickly, and there's a lot that we covered there, so we'll take a moment to address any questions before we call Adam up for the year-end financial planning tips.
Wow, we must have done a good job. Yes.
Yeah, so the question was about climate change and kind of what we think that would impact. In the short term, I'm not sure if there'd be a large impact. In the longer term, which is really where climate change would be addressed, I do think you'd see a change, not necessarily for this market cycle, but in how companies gear up their portfolios and how they run their businesses. We've already started to see that happen. Unfortunately, in my mind, it's become a little bit of a buzzword. You hear the letters ESG thrown around quite a bit. ESG is environmental, societal, and governmental influences. But that's a start, in my opinion. And the more companies start to address those and incorporate them, I think that's where you're going to see the larger change when it comes to climate. So it's not necessarily us adjusting the portfolio, but if we have more companies to pick from that are embracing that value system and that methodology, well, then you have more investments to pick, and then you can actually start building a fully diversified portfolio around that. And I think we're just at the starting point of that cycle.
Yeah, and the climate change is more along the lines of what I would look at for the electric car as opposed to, say, the flat screen TV. Flat screen TVs came out, and within an 8 to 10 year period, there were no more tubes. It was really quick because prices came down and you could manufacture it. The electric car may take a little longer to do because there's a huge infrastructure play that you have to deal with. How many places can you get set up? Where can I plug in? All these other options. How far can I go? What are batteries going to be? Once that problem's solved, everything will go through the same way. This is pretty much there. Everybody still relies on oil globally, and global oil still is increasing. So until we stop doing some of that, it may take a while. But yeah, Clint mentioned it, right? It's something that's at least working towards getting there, and we're not just quite there at this cycle yet.
Yeah. Good question, though. We have another one back there. Yeah, I'm a little biased.
That's loaded.
The question.
We'll talk after this.
Yeah. The question was what to do with a lump sum of money right now, and I think it has to come back to the time frame and the objective. If you say, you know what, this is long term, I don't need the money for 5 years, well, I'd say the market's a pretty good place. When things go down, often you see some opportunities. The old adage, buy low and sell high. That doesn't mean that next month it's going to be up, but if you're going to leave it alone for 5 years, you'll probably be very happy with today's prices, because 5 years from now, very confident it'll be much higher. But if you think I need the money in the short term, I might need it, in a year for a purchase or something of that nature, you probably want to leave it in the bank. Short-term money, you want to leave alone. Longer-term money, I'd say there's actually some pretty good opportunities in the markets. Yeah. And earlier, so the question was about adjusting a portfolio in a down market, and that would be the prior slide. We had a couple of items that would trigger us to make changes. Essentially, you have to make it more defensive. You need less market exposure. You need more exposure to the safe assets, which in this environment have really been your alternative assets, your real estate, your infrastructure, even to some extent your GICs. So that would be the change. You're really reducing your market exposure and you're adding in more of those safe assets. But the timing piece is always tricky, and those are that prior slide. We had 3 items we're watching to see the timing of that change if we do have to make that change.
And again, on the stock side, we would look at things exactly as Clint said. They'd be more defensive. You might be in banks, you might be in telcos, things that we're going to be around for the long term, pay a distribution of some format, so at least you're getting paid to wait till it comes around. That's sort of a scenario, as opposed to going directly into something that's growth-oriented or more tech scenario.
Yeah. Good. Well, we're going to jump into the stir-fry bar there, yes. And we're going to hand things over to Adam to walk us through some financial planning year-end tips.
Excellent. Can everybody hear me all right here? Perfect. So a couple of weeks back, Kevin approached me and said that I have tried everybody possible to come and do this presentation, and everybody said no or they were busy. Can you please come and do it for me? So I'm very happy to be here as their absolute last choice to do this. So thank you guys. Appreciate it. It's always good to be here. He was also very specific that I actually had to dress up, wear a suit, and in particular, I had to wear pants for this presentation. So that's a new concept over the last 2 years. So as I mentioned, Adam Buss, Wealth and Estate Planning Specialist on the team. I'm here to look after clients' financial planning needs. So what do I do essentially? Again, it's really small. Look at, doing retirement planning, estate, tax strategies, trying to help you accomplish all your goals and objectives, ideally as tax efficiently as possible. So what are we going to go through today? So year-end financial planning and tax tips. So of course, I am not a lawyer, I'm not an accountant, even though I have way too many letters behind my name, none of them are an accountant. So I can't directly give you tax advice. Certainly want to engage with your tax and legal professionals before acting on anything specific to your situation. Some of the slides I'm going to go through today are courtesy of Angela Preto, CPA here in Winnipeg, cross-border tax specialist. So if ever you're looking for an accountant, certainly one that you can reach out to. So tax system, I'll go through Manitoba as an example. So tiered tax rates. So this kind of forms the foundation of a lot of the planning strategies that we look at for clients. So using these tax brackets to your advantage in a variety of different ways, whether that's on the pre-retirement, getting your best bang for your buck from RSP contributions, or trying to figure out the meltdown strategies, which we'll go through some of that. So one of the concepts that we often discuss with clients, and especially through doing a detailed financial plan, is the concept of an RSP meltdown, or what we also call as a drawdown strategy. So again, using your tax brackets to your advantage. If we're looking at 2022 specifically, are you in a low tax bracket today? Is there room that you can take advantage of within your tax bracket? Let's top off your income and shift some funds ideally to your TFSA or your non-registered account by controlling the level of tax that you're paying when withdrawing it from the RSP or a RIF. So quick random example for you. We'll pick a client name out of thin air. We'll call him Clinton. Clinton is retired and estimates his annual income by the end of the year would be about $46,500. So in this example, tax brackets in Manitoba between $34,000 and change and just over $50,000, which means that he could take an extra, call it $3,700 out of his RRSP or a RIF, and he knows what tax rate he's going to be paying at 27.75%. So it's all a matter of just trying to get money as tax efficiently as we can out of the RSP and try to control what tax bracket you're in and what rate of tax you're going to pay on it. Of course, everybody's got a different situation. Certainly got to be mindful if there's old age security clawback that plays into the mix. But these are things that we look at. I usually say November, December is a great time of year to do this, as you'll have a good idea as to what your income level has already been throughout the calendar year and how much room there might be in your tax bracket. Obviously, you got to do a little projecting forward for November, December, but it gives you a fairly good idea as to where you would be at. Income splitting, again, one of the things we look at. So certain income types are eligible for income splitting. Generally, this is not something you need to worry about on a day-to-day basis. This is the accountant's problem who's filing a tax return and moving income between the two tax returns to make it as efficient as possible. So prior to the age of 65, basically any money you're receiving from a defined benefit pension plan qualifies for income splitting. After the age of 65, money coming from a RIF account can qualify as well as a few other options there. So often if we're starting to do a drawdown, we'll encourage clients to convert either fully or partially their RSP into a RIF so that we can make some of that income eligible for pension income splitting, as well as the pension tax credit as well, if that happens to apply. What are the effects of income splitting? So a quick example for you. We'll go to the extreme right-hand side here. Assuming a couple could split their income exactly down the middle, probably doesn't work out exactly that way, but again, rough example. If they have $100,000 as income as a couple, split 50-50 versus all as one person, they save about $7,700 a year in tax. That's quite a bit of extra money in your pocket. That's maybe an extra month or two in Arizona playing pickleball, or maybe that's enough lessons to fix my golf game. One of the two could be a possibility in retirement. So again, these are things that we will look at, and again, just trying to make it more tax efficient as a couple, keep more money in your pocket, and of course, if one individual had $100,000 of income, they would experience some old age security clawback as a result of that, versus split between two people should not be a problem. U.S. Canadian tax filing requirements, obviously file taxes, kind of important. If you live in Canada, it's based on residency. So if you're outside of Canada, you happen to retire somewhere else, they're only going to tax you on Canadian source income. So you still need to file a tax return for that. If you are a U.S. citizen, doesn't matter where you are, they're going to find you and want their tax money as a result of it. So there are extra tax filing requirements, even if you're a U.S. citizen living in Canada, something to discuss with your cross-border tax specialist. So the big one we often get asked is, should I contribute to an RSP or should I contribute to a TFSA? Well, the answer is always both. If you have enough money that you can, throw money into both plans, great. That's the ideal solution. But not everybody has an unlimited pot of money that we can throw into all these different investment strategies. You can use your RSP tax refunds to put that into your TFSA. So if you contribute this year, you get a tax refund come April, great. Let's use some of that cash to top off your TFSA. It's always nice going into retirement if you have a balance of both tax-free money that you can access and also taxable money, with obviously the whole idea trying to shift tax bracket between now and retirement. If I'm in a 46% tax bracket now, but I'll be in 30% in retirement, clearly that's where an RSP is going to be the best strategy, as I'm going to be in a lower tax bracket come retirement versus what I am today working. Ballpark rule of thumb I use, if your income's under about $50,000 a year, probably going to be in the same tax bracket at retirement time, so maybe a TFSA might make the most sense versus an RSP. And over $50,000, again, maybe an RSP is priority. It's not necessarily a blanket statement that this applies for everybody. It really does depend. It depends what makes sense for your goals, objectives, and concerns. Of course, if you're saving money in a TFSA for your retirement, make sure that you remember that that is for your retirement, not buying the shiny new boat that you see in the showroom along the way. Otherwise, you're not going to have anything left there. RSP contributions, tax deductible, straight dollar for dollar deduction, reduction in your income. So if I make $100,000 a year, I put $20,000 into an RSP, I am taxed as if I earned $80,000. So maybe that generates a refund. Maybe that's just already offset on payroll deductions. Depends what is the case. So again, the goal is just to reduce your income, ideally to a lower tax bracket. So some years we may say, well, instead of putting in $20,000 to the RSP, maybe it makes sense just to put $10,000 because that's where you're dropping a tax bracket, and anything beyond that doesn't really make sense for your particular income situation. So again, those are things that you want to discuss with your advisor, get the right advice, and try to find what is the right amount of money to contribute for your RSP. Helps with income splitting down the road. You can use a spousal RSP to split income as a proactive way. And of course, remember that you can contribute before the end of the year you turn 71. After that, no more RSP contributions. All of your RSP is then converted to a RIF. Tax-free savings account. So current limit is $81,500, $6,000 of new room every year until they decide to do away with that, which hopefully is never the case. Unlike an RSP, contributions are not tax deductible, but again, unlike an RSP, they're not taxable on the way out either, which is really nice. So all in all, the income that is acquired or grown within that account is completely tax-free. So certainly something to take advantage of. And again, that is tax-free in Canada. There are different rules that apply if you are a U.S. citizen. I strongly encourage anybody who is a U.S. citizen to discuss it with a cross-border tax specialist before getting a TFSA, because it is a bit more complicated as to how the U.S. views them, as it is not tax exempt on the American side of the border. You can have multiple TFSAs at the same time. Just obviously be mindful if you have 3 different TFSAs at 3 different financial institutions and they're all telling you to put $6,000 in, you are going to be over-contributed with a nasty penalty of 1% per month. So ideally, don't do that. The simplest solution is just to have all of your TFSAs with Clinton or Kevin. Yeah, okay, good. I get paid when they say that. So yeah, and you have the same investment options inside a TFSA as you do on the RSP. You're not limited to just having a savings account at the bank. You can have that money for long asset allocation and growth aspect to it. Often in retirement, we're still funneling money into that account, and it's one of the hopefully last pots of money that we need to touch later in life. TFSAs continue. I think I already touched on some of this, but again, you can take the money out anytime from the TFSA. You can put the money back again in a future year. Any dollar that you take out, you regain that contribution room back as of the next calendar year. So if I took out 20 grand today, I can't put that 20 grand back until January 1st next year unless I already had surplus room. I think I've already covered the rest of this, but again, if you're not taking advantage of the account, certainly chat with Clinton and Kevin and they can help you out. Capital losses, I'm sure that does not apply in 2022. But if you do want to take advantage of tax loss selling, basically selling an investment at a loss to get the tax advantage to offset a different capital gain. You can carry the loss forward, I think it's indefinitely or until you pass away anyways, or you can carry it back 3 years to offset previous capital gains. You do want to be mindful that you don't create what's called a superficial loss, which is repurchasing that same investment within a 30-day time period. Then CRA says, no, you don't get to use that loss. Too bad, so sad. You rebought the same security. So usually Clinton and Kevin kind of are mindful of that and make sure that doesn't happen. Do you have capital losses from a previous year? Because that can be a good way to offset capital gains. Does it make sense in your accounts to trigger any large capital gains in a non-registered account specifically, either fully or partially? So maybe you have a stock that's just boomed over the years and you're trying to figure out how to slowly get out of it, but you don't want that big tax hit. Maybe it makes sense to take it this year. Maybe it makes sense to take part of it this year, part of it next year. Just come up with a plan and a strategy as to how to lessen the tax hit from that. And as if you have too big of a capital gain, especially beyond the age of 65, again, you might experience some old age security clawback, so something to look at. Again, discuss with your advisor, your tax accountant, and come up with a plan as to how to address that. Of course, that can apply to real estate as well, so those people that maybe have multiple rental properties and do want to start selling them off, if you can avoid selling them all in one particular tax year, that would be good, so that you're spreading that income out perhaps over a few years. Again, depends on your situation, depends what's right, depends on the real estate market at that point in time as to what makes the most sense. RESPs, so maybe it doesn't sound like a tax strategy, but it is a year-end planning reminder. So if you have RESPs or a family member has them and they're still eligible for contributions, try to use your contribution room, the maximum of $50,000 for the life of the program. Make up for an unused contribution room. You're allowed to double up to a total of $5,000 of contribution. A big one to remember is if the beneficiary turns 17 this calendar year, you have till the end of the calendar year to get a contribution to still be eligible for grant money. If you have a child whose birthday is unfortunately December 31st when they turn 17, that's it. That's the end of the calendar year. That's your last year to contribute to the RESP and get grant money. There's also rules that if there isn't enough money or certain funding levels aren't met by the time they turn 15, then they won't be eligible for grant money at 16 and 17. So again, certain things that you do want to keep track of so that you can get your best bang for your buck for some free money from the government towards their education costs. I always think it's a good idea as well. The closer they get to university age, it's always good just to revisit your asset allocation versus the beneficiary age. I mean, if you got all of your grandkids or your child's money in Bitcoin at this point in time and they're approaching university age, might be a good time to reevaluate things. So some tax credits that are available, primary caregiver tax credit. There's a lot of information on this page. Again, we're looking here specifically at Manitoba. If anybody's watching this later online from a different province, check with your province to find out what applies. If you are considered a primary caregiver, there is I'm sure, a very lengthy form on the Government of Manitoba website. Some of it I'll allude to on the coming slides. Look through it, see if it applies. If it does, great. Take advantage of the tax credit that's available to you. It's approximately $1,400 a year. Certainly probably doesn't offset most of the costs of being a primary caregiver, but it does put a dent into it as well. Some basic questions on the primary caregiver form from the Manitoba government. It does cover some of the requirements. I'm not going to go through them in depth. It is there for your reference. Again, if you think this applies to you, chat with your accountant, chat with a physician to find out as to what it takes to qualify for this, and again, get the tax credit that you're owed. Same form, except it's for a minor under the age of 18, so even smaller writing for you to try to read. But again, similar set of questions, basically just trying to identify if you meet the criteria for the primary caregiver tax credit. Charitable donations. So you can get a non-refundable tax credit for eligible amounts. So if you are charitably inclined, lots of different ways that you can accomplish this. You can claim up to 75% of your annual income, except for the year of death, where you can claim 100%. So anybody leaving money through the estate to a charity can be a great way to also offset any estate taxes that would be owed. You can carry forward donations. As much as you would like to think, your children are not a qualified charity, even though they may be expensive at times. They are not a charity. I know. People ask, can I use my child as a charity? No, you cannot use a child as a charity. I'll be your charity. No, just kidding. Somebody was offering to hand out cash earlier, so I'm available if you need. Charitable donations. So how does it work? So large tax credit when donations are claimed all on one spouse's return, because there are certain dollar amounts. So if one spouse is claiming $10 and the other one's claiming $200 or $190, perhaps it makes sense to combine them so that it gets bumped to the next category for the donation to get a higher eligible refund amount. You can do in-kind donations, so we'll look at this for clients. Perhaps they have a stock or a holding in their non-registered account. Maybe it has a large capital gain on it. They do want to give money to charity. It might make sense to give that stock in kind to that particular charity. And that helps avoid the tax bill that is for triggering that capital gain on that stock holding. So it can be a great way to help reduce tax, give money to charity, and of course reduce your tax burden from giving a charitable donation. So some of the tax credit amounts are up on the screen for you, both on the federal level and Manitoba. Again, if you're from out of province and you drove here, that's great. Didn't think anybody would come from out of province, but if you are watching online later, check with your province as to what applies. Lots of different ways that we can look at charitable giving. Again, depends on what your goals are, what makes sense for you. We'll look at through the estate, through a will. We'll look at gifting of life insurance, both an existing policy or perhaps a new policy. Lots of different ways that can be accomplished. Gifts in kind, using a foundation, a private foundation, or we can do something what's called the donor advised fund. So those are things that we can do in the office. If you have a large amount, perhaps that you want to give to charity, but you want to sprinkle it to them over several years, but you want the big tax receipt in the first year, we can use something called a donor advised fund, which is kind of like a foundation light version that doesn't have all of the crazy costs associated with running it behind the scenes. So if that is something of interest to you, certainly discuss with your advisor. Medical expenses. So if you do you have medical expenses throughout the year, certainly track them, certainly see what is considered eligible, what's not considered eligible, including medical insurance premiums, prescriptions that aren't covered, nursing home, go to the chiropractor, physio, dentist, all of those fun and exciting things that we need to do on a regular basis. If you're traveling to any of these individuals, you can claim meal expenses, you can claim mileage. There are certain parameters. So again, certainly look at that, discuss it with your tax professional. And it's all about just trying to make sure that you're getting credit for everything possible on the tax return. It's a non-refundable tax credit. It is not an unlimited dollar amount, as nice as that would be, especially for some people that do have higher medical expenses. It is quite limited. It's 3% of your net income as a threshold to an annual maximum. This is 2021 number, about $2,400. So it's not a substantial amount that you can write off, but hey, again, it's something. It would be nice if it was a higher amount for those that experience high medical costs throughout their lifetime. Tax-deductible expenses. Makes a big difference if you're self-employed or if you are an employee. Are you using a house? Are you using a vehicle? What's considered eligible? If you're on the employee side, you got to make sure that your employer, HR department, boss is giving you a signed T2200 Declaration of Conditions of Employment, which says that you are, using a home office, or you have to use a vehicle, or you have to use a personal cell phone for business-related expenses, which allows you to have some deductible abilities on those expenses. So if you are not sure, certainly track it, discuss again with your accountant. If you do have to use, personal resources when you're on the job, maybe a commissioned salesperson, again, discuss it with your employer, see if they're going to give you that form along the way. If not, strongly encourage them to do so. Home office expenses, so looking at what is eligible, how do they calculate it? As much as I try to justify that I'm using all of my square footage in my house for business purposes, it just doesn't fly. They'll generally only let you use a percentage based on your actual office space. So if your office is 100 square feet, you have a 1,000 square foot home, well, you get to write off 10%. You can try to fight more than that, but you're probably not going to win. But again, those would be things that you calculate with the accountant. You can't write off everything. Certain things do apply. So you're looking at mortgage interest rate, rent payments, insurance, electricity, heat, property taxes, alarm, internet, maybe repairs and maintenance. You can't deduct property tax unless you are a commissioned employee or self-employed, obviously. Again, you need to submit the expenses. There is an exception for the last 2 years, I believe 2022 still inclusive. If you are using home office during the COVID time period, there is a simplified method that you can actually use for deduction purposes, which is a flat amount on a daily basis up to a preset dollar. So again, if these conditions happen to apply for you, again, discuss it with your tax professional and make sure that, again, you're getting some money back if you're eligible for it. Yeah, it does say you must actually work from home. It is important. Foreign investments. So there is some additional tax reporting requirements if you do have foreign investments of more than $100,000. Something to be aware of. Even if you have, U.S. stock holdings, specifically on the U.S. stock exchange, even if it's in a Canadian account, those are things that need to be reported if it's more than $100,000. This is separate from if you're an American citizen and you just have to report basically everything that you do on a daily basis, probably, to the government. This is specifically on the Canadian side. And of course, anything that is not being reported, you do get a lovely penalty charge for late filing. So just keep your accountant apprised as to what's going on in your situation so that all the proper forms can be filled out. There are exemptions, which is personal use foreign real estate, which is nice. So if you have that property in Phoenix for when you go down south to play pickleball, you don't have to claim it, or you don't have to put an extra form unless you're also using that as a rental property along the way. That's a little different. That might have some extra reporting requirements to it. A little bit more just on the form requirements here. I won't go through that in great depth, but it is there for your reference. Then we'll end off with some general tips. So again, always good. This is my planner hat being on. Review your estate documentation, your wills, power of attorneys, healthcare directives. If they're in place but they're old, they're probably still perfectly valid and may accomplish your goals, but make sure the wording encompasses all the situations that could arise, different what-if situations. Make sure the wills and the beneficiaries that you might have on your RSP or TFSA are in line with each other and not contradicting each other. Review your life insurance needs. Has anything changed? Did I buy this life insurance policy when I was single and had no kids? Well, maybe I have kids and I have a mortgage now. That life insurance policy might not be good enough. Have you considered the tax-exempt advantages and benefits of having a whole life policy to accomplish those long-term estate goals, or as a tax tool? When was the last time we reviewed your financial plan? Always a good time to give it a revisit. Has anything changed in life? Have you recently retired? Has it been a couple of years? Just to make sure everything's on track. Sometimes even in a down market, it's good to know, okay, is everything still on track even though my portfolio is slightly down? Utilize your health insurance plan. So a lot of these things do reset at the end of the calendar year. So if you have a lot of benefits in your health plan that you haven't used, maybe it's chiropractor or massage or physiotherapist or something like that, maybe a health spending account, you definitely want to take advantage and use those. Otherwise, you're just going to lose the benefit when it resets. Not the prescription one. It's not like I'm saying go and get $10,000 worth of prescriptions before the end of the year, unless you need them. Lastly is pay prescribed loan interest rate payments by January 30th. If you have no idea what I'm talking about, then it probably doesn't apply to you. But if you do, it's maybe a spousal loan, maybe it's a prescribed rate loan to a family trust. In order for that to maintain its structure, the interest payment has to be made by January 30th every year. And I believe that is it in a nutshell.
Yeah. Thank you very much for showing up. This has been our first event. We are really thrilled with the fact that you came out, and we're really appreciative of it. So all we have to say now is you don't have to go home, but you can't stay here. So thank you very much for coming out.
Take care, everyone.